Let's get our prominent voice into our studios, and we have a special guest right here with us. Rajeev Thakkar, who's the CIO of PPFAS Mutual Fund, joins in with his perspective on the markets. Rajeev, it's great to have you. Thanks very much for stopping by.
Pleasure being here.
Give us your opinion, your opening take on the markets. We've come out of a fairly volatile month of May, especially with the mid caps and the small caps. Have things settled now in June, you think, June onwards?
So, you can call me a broken clock on the 80 Now show. Just before coming into the studio, I was just going through our past fact sheets. So, from April of 2017, where we started holding about 17% cash, to today where we have about 23% cash, we've been cautious on the market, and hopefully like a broken clock, sometime I'll give the correct time. So, even the broken clock is right twice a day. But like yesterday was Avenue Supermart analyst meet, and great company, great promoter, everything fine. But at 125 times earnings, I don't see how one can justify a buy, forget a buy, even holding on to such companies. And this is just one random name, whether you talk about Page Industries or Group Finance or anything to do with consumption.
So you think the market is getting polarized, where the expensive names are getting more expensive, and there's a big, the differentiation in valuations is getting stretched even more?
What has happened is only the first correction in the bad quality names or where there were governance issues has happened. So some of the fraudulent companies, or where there's a question mark of auditors resigning and things like that, those have fallen out of favor. The expensive quality names are still expensive, and all the indicators are very clear, saying that liquidity will be tight. Fed is reducing its balance sheet, EU QE is coming to an end by 2018, and we are going into next 12 months of so tightening cycle is one, and we are going into an election cycle in India, which is always jittery for the markets for whatever reason, and this time may not be as easy to get a comfortable majority government as was last time.
So for the broader markets, you would say that valuations is the key concern right now?
Three concerns: valuations, tightening liquidity and interest rate cycle, and for India, the election season coming in. I think these three will be hogging the headlights.
But does that mean that you're, what's your broad overview? Are you cautiously optimistic? Are you cautious? Is there, tone of being circumspect and not taking fresh calls in the market? How would you define your mood?
Sure. So, I talk in percentage terms. So, I am 77% optimistic, given that we have 23% in cash. So, our approach is bottom up. So, ignoring all that I have said since we started talking, our approach is company by company. We look at each company on its own merits, how the business is going to pan out in the future, what are the valuation levels like. But from a broader perspective, I think we are not in a cheap market, and we are going into a tightening scenario.
So at what point then, either an index level or a market indicator, would you want to deploy this 23% cash that you're sitting on, or even at a level when you'd want the cash levels to go up?
Sure. So cash is residual position for us. We are not looking at a particular index level or a particular index multiple. If a particular company is available attractive, regardless of whether the market is expensive or not, we would go out and deploy. So even in the last 1 year, where we have had increase in overall cash levels, we have actually bought companies. So it's not that we stop looking at buying opportunities, but historically what we have seen is 12, 13 times earnings multiple are screaming buys for the overall market on the index level, and any time we are closer to 23, 24, 25, then that is a sign of caution. So we are closer to the upper bound of the valuation levels for the market as compared to being cheap. And the small and mid cap space, despite the ups and downs, is still expensive.
So where do you think the next wave of correction within mid and small caps is going to come? Because a large part of the correction has already taken place. We're down 9 to 10 odd % within small caps in just the last month gone by. But yet again, like you're saying rightly, that there is still a lot of mid and small caps out there which are still sitting at their peak valuations. True. So when will this next wave or leg of correction play out? And will it play out in the first place?
So, the up move happens on optimism, happens on all stories coming about earnings growth, and this time it's different and backed by a lot of money, cheap money, easy money. So, cheap money, easy money, when it goes out, automatically people have to come back to their senses, and as long as money is there in the bank account, you can buy anything, and even an overvalued thing can still go up. But when people do not have money, and we have seen only outflows in the debt segment from FIIs, we haven't seen any significant selling in the equity space so far. If that were to turn, then obviously a lot of froth would go away.
Pharma and IT, is that the alpha opportunity now? I mean, see, either ways, there's a high correlation in how these stocks move. There might be a news on Dr. Reddy's, but the whole pharma pack will suddenly rise, right? That's the typical case with IT. The rupee is favoring them. Do you think that for an alpha manager, it's time to go in?
So, the train has started moving. We have been buying into this space over the last 12 months and even before, thinking that a lot of pessimism is built into it. So, the rupee is helping them. The quality issues are seemingly behind the pharma companies, and overall developed country growth is positive again for IT space. So, I think these will do well, but again, one should not be trying to catch a running train or just get on at
but with
whatever.
pharma, it's not even like, is it really a running
True,
train?
it's early stages.
It's early stages. I
It's
mean, if
early
you were to
stages.
take a strong position on pharma today, given the news flow, and I'm not saying that this is a foregone conclusion, but 6 months down the line, you could benefit, right?
Yes.
You could still see a chunk of the
That's
upside.
true. That's true.
Okay. So, where else outside of IT and pharma is there opportunity, given the polarized nature of the market, where the index is only 3% off from its high, and we all know what's going on with the side market?
So, the opportunities will come in individual companies rather than overall sectoral things.
Sure.
So, what happens in a sell-off many a times is the sell-off is indiscriminate. People then don't see whether this company is overvalued or not, or what is the valuation. Whenever the sell-off comes on the back of either equity redemptions from mutual funds or because of F&O margin calls or selling by lenders, then that selling is indiscriminate. I think if one has cash, one will find plenty of opportunities in the next 6 to 12 months, given where we are headed to.
But where would you hunt? Would you restrict yourself with quality which is looking expensive, but you know that there is growth, it's been visible, there is a historical record for that? Or would you try and play those bottom-up stories where there is hope and anticipation that there could be growth at some point and yeah, valuation is dirt cheap?
I think some quality names will start reflecting or will start trading at attractive valuation. We are already seeing some of them coming close to maybe buying levels. One should stay away actually from the bad quality names. So, what happens is a lot of people are living on leverage, and we have seen how banks are getting tough in terms of appointing auditors to do forensic audits. We have seen whenever there's this NCLT resolution and all, the stock price is effectively going to zero because only the lenders get back part of the money, equity shareholders get nothing. And again, we have seen how people are saying we'll do buybacks and then reneging on that, and auditors resigning and all. I think the market will be brutal for the low quality names. High quality will be the buying opportunity, given that we are headed
I have a
to
question, and I've seen ICICI Bank and Axis Bank. I'm not asking you to talk stocks. In every portfolio, we know what's happening with the business. We know that those stocks have not performed. I think first the premise for a lot of fund managers was the fact that things will turn around as the corporate cycle picks up. Investment-led demand will drive these companies' businesses given their profile. Now there's another overarching theme with how do you manage the business? Who's going to manage the business? What kind of leadership profile will take these businesses forward? Why is there such a high conviction among fund managers to have an allocation? I can understand the HDFC banks of the world and SBI as well, but why ICICI Bank, Axis Bank, pretty much being part of every large cap portfolio?
Sure. So, the question that we have today is, do we buy, let's say, a HDFC Bank or a Kotak Bank at maybe 4.5, 5 times price to book? or do we buy maybe ICICI banks, Axis banks with maybe 1 to 2 times book? Is the problem so severe that after writing off all the losses, after having a clean balance sheet, will they still be far more expensive than the other ones? See, while something like a Kotak or arguably some would argue maybe some of the newer banks, let's say RBL, IndusInd, Yes Bank, would have lesser of NPA problems. But I would argue that retail franchise is of lower value because they are having to purchase CASA by paying 6%, 7% on the savings account. Whereas these players, ICICI Bank, Axis Bank, they have had a big legacy of a large retail operation. They have numerous branches, customer base, they have additional businesses, especially in ICICI in terms of insurance, mutual fund, stock brokerage, distribution, merchant banking. So all of that franchise is currently under a cloud because of the NPA issue and because of the management issues. Now, this is not a promoter run company where the promoter owns 60% and you can't do anything to the promoter. Government nominees are on the board and there are plenty of capable people who can step up and run the bank. I don't see that as an issue.
So you have a positive view there?
It's among the smaller holdings in our portfolio. So HDFC Bank is 6.5%.
Yeah.
These put together would be about 3%, 3-4%.
Rajeev, you also have an exposure to some of the FANG stocks, and the reason that I bring that up is because while what our market is doing is one story, but look what's happening across US equities and especially NASDAQ. That just last night we're sitting at an all-time peak. Is the valuation concern not valid for the FANG names? Because that's been the big story, that big bubble which everyone's worried is going to go bust sometime.
So what valuations do these two companies trade at, Alphabet and Facebook?
At their peak valuations, don't they?
Do you have a number, let's say price
No.
earning multiple?
No.
These would be cheaper than, these would be maybe a quarter of Avenue Supermart's valuations.
Okay.
So
that gives the answer in itself then.
So actually,
so you're waiting for them to scale up to Avenue Supermart level and then maybe sell out.
So what's Alphabet's valuation?
It would be about 25-30 times earnings.
20, but you're talking about a business which is a multiple of
Which
any
is huge.
business in India.
Yes, yes.
So at that value, at that market cap, having a valuation of 25
The
times
GDP,
is
not
like
just stock
is
valuations,
significant, right?
Sure.
I mean,
So-
for them, 25 times is a lot more than for us at 25 times.
Absolutely. So the reason why people get worried is the headline numbers. All of these companies are close to $1 trillion valuations. Apple, Amazon, Microsoft. Now Netflix and Amazon, you can't value them on earnings. Those are looking very, very frothy. But Facebook and Alphabet are, you can value them on conventional basis and they are not looking expensive. Especially when you account for the fact that in Alphabet, they are spending billions and billions of dollars on products which are not earning them any revenue right now. So these numbers are after expensing out all of that. So if something like this Waymo self-driving car hits off, or some of their device plays where Google Home or phones and notebooks and all of these. So they have multiple businesses which are currently not earning anything for them.
And that's
So
what
you
you
have
think the
free
market
lottery
is
tickets.
pricing in. So at no point in time would you look to reduce your position or...
Not right now, for sure.
Okay, you believe growth is intact and the valuations do justify
These
the
are
story.
growing at north of 25 times in dollar terms, and that is in terms of top line revenue. The volume of usage is even more. It's close to 40% CAGR in terms of number of clicks, time spent on their sites and all of that.
Okay, fair point. Rajeev, good to get you on the show. Thanks so much
Pleasure
for
being
taking the time out and speaking with us today.